It's week number 6, Business 630 students here in our online Spring 2 session. Today's date is Tuesday, May 9th, and this is our introductory or lecture video for week 6. Today we're going to talk about the financial statement analysis, basically chapter 3 of our text, and we have a couple examples. You're going to be doing something very similar to this lecture in your case number 3, which we posted this coming weekend, due May 21st, where you'll be doing a PowerPoint presentation of a financial statement analysis of the company that you selected way back in the first week of the course that you did case number 1 on as a credit analysis. You'll be doing a financial statement analysis of your firm in case number 3 to be posted this weekend, and it'll be in a PowerPoint format. We also will talk about in our Friday weekend update video forecasting financial requirements or funding expansion with from chapter 12. One of the key things of financial managers is to forecast and to determine their capital needs going forward into the future. And that's our subject of our Friday video. Also, this week, number 6, you have 2 articles to read that are posted in Blackboard, and I'll show you where those are in a minute. 2 articles, a model for effective financial analysis, and another article on analysis of financial statements, the importance of financial indicators in enterprise. So 2 articles which will lead to your work in case number 3. So let's take a look as we begin week 6 of where we are in Blackboard and begin our lecture video. As we begin week 6, winding down our course in the next 3 weeks, remember in the next 3 weeks we have the following assessments and grades to be due. Case number 2, most of the grades have been posted now to Blackboard, and I have reviewed your work. Some students still remain, but most of the case 2 work has now been graded and available for your review in Blackboard. Remember, case number 2 is practice for the electrics case, and we'll talk more about that in a few minutes. Then next weekend, or this coming weekend, case number 3 will be posted, as I just explained, the PowerPoint financial statement analysis of the company you selected for this course. And our final grade, which you're working on now and we'll have subsequent videos about over the next few weeks, is your course assessment case paper, the electrics case, where you're doing a spreadsheet analysis of a capital budget decision for 2 products. And then once you complete that spreadsheet analysis, you are to write and interpret in an APA format paper your analysis of that case. And that's our work as we head into the final 3 weeks of our course. Case number 2 grades are posted. Case number 3 will be this coming weekend, due May 21st. And then our course assessment case paper due on Sunday, May 28th. In regards to that course assessment paper, we will have a review session for that on Saturday, May 20th, a week before that case is due. We will have a review session that will be recorded for students who cannot make it. I know that's Saturday, May 20th is Multicultural Graduation Day for many of our University of La Verne students. I will be attending that multicultural graduation, but at the same time, I will be back and have a open session on Zoom and also recording it to answer questions and do a final review of the electrics case. Also, we can also answer questions on that Saturday if anybody has any open items in regards to case number 3. But also there'll be a special video this coming weekend. As I introduce case number 3, I also, part of that weekend video, which will be posted on Sunday, will also do an additional review of the electrics case. It's going to be entitled The Checklist for the case, a series of checked items that you need to complete and in the order so you can complete the spreadsheet and interpret the data for the analysis. Again, case number 2 practiced that format exactly the way you did it, taking variables, determining the cash flow, determining the return analysis, doing a sensitivity analysis with scenario and sensitivity analysis and risk. That is all being done. And so you now have that completed template to help you with your electrics case. Now, the problem, well, though, is the electrics case, the variables are not given to you in a nice, neat little template format. You have to create or interpret the variables. What are the variable costs, the fixed cost, and so on? That's the key to the electrics case, is for you to interpret all the data and put it in a format so you can do the analysis. So we will have a review session Saturday, May 20th, and there'll be a review video posted this Sunday, May 14th. There's no other graded work due this week. The only graded work you're doing is that electrics case has been posted, but you have a few weeks to do that. But at the same time, I strongly urge you to download those files and read the case and see what you get and what you don't get out of that case. This is a typical MBA case study interpretation and analysis. So it's a very important part of our course work. Again, here is that case work and the files associated with it for the electrics case. We are now in week 6. We will have, here's our learning assignments for this week. You have 2 articles. Here are those articles right here. You need to download them and read them because they will pertain to your case number 3 work that's posted this coming weekend. So I strongly urge you to review those articles. Here's the spreadsheet that we're going to review as our lecture video today. We're going to look at financial statement analysis of a company and interpret what it tells us. And also here's a financial statement spreadsheet or analysis taken from our textbook of key financial statement indicators and how to calculate them. And I'll go over that in just a few minutes. So that's where we stand currently in Blackboard. So let's begin financial analysis and forecasting, week number 6. Okay, here's a spreadsheet in week 6 that's entitled week 6 lecture review. And it's a series of tabs to talk about the key points of strategic decision making and analysis in regards to financial statements. What have we done so far in this class through the first 5 weeks? We have taken a look at and selected a company and done a risk analysis, learning about risk and return, learning about how a company is situated as far as their credit rating, what's their cost of capital, what's their cost of equity, what's their weighted average cost of capital, what's their beta, and how this all plays into the risk evaluation of the company. Then we went into taking an account of capital budgeting, understanding what stocks and bonds are in the formation of capital, taking those stocks and bonds and capital that you fundraise and investing in an asset and finding out whether that asset is in a good return by doing a capital budget and risk analysis. Now, once we've invested in that risk analysis and once we've invested in that asset, how do we interpret how that asset is performing overall in the company? By reviewing their financial statements. What are the key financial statements of a company? The income statement, the balance sheet, and the statement of cash flows. We should be all familiar from our accounting days of what those statements tell us about a company and how that we interpret them. The second part of our week video is on Friday when we take a look at, okay, we have the financial information currently. How does this financial information use to project into the future our needs for capital going forward with the company? It's called the percent of sales method, or another word for that is the additional funds needed method of financial forecasting, which we'll talk about from chapter 12, which is the question number 3 on this page right here. Today, we're going to concentrate on the first 2 parts. The statement of cash flow being driven off the 3 financial statements that I just mentioned, and that tells us about the efficiency and return of the company, and then the trends associated with the company. Taking a look at current ratio, debt ratio, profit margin on sales, return on total assets, price earnings ratio, earnings per share. probably the most important financial analytical terms that people in finance, in business, in banking, in stock management all look at about the performance of a company. You are going to be asked to take a look at those from this company that I've given you. This is a real company. The data or the numbers have been changed to protect the innocent, but these are the real financial statements of a company through December 31st, 2022, and we're going to look at those. I like to call financial statement analysis looking under the hood of a company. When you buy a new car or looking at a new car, especially if that car is used or has been around for a while, you take a look at the outside. Is the car painted and no cracks or no trouble with the paint or the dents in the car? The interior is nice and clean. But the key part of purchasing a car is how is it running? How's the engine? By looking under the hood at how the engine is performing. Is it efficient? Is it doing well? That tells you whether you'll buy the car or not. And the same thing with companies. Looking under the hood, taking a snapshot in time, in this case 2021 and 22, how is the company performing? Are they generating a profit? Are they generating capital? Are they generating a return on investment? These are all key indicators about your decision making and assets. Are those assets performing what you need to satisfy your investors, to satisfy your creditors, and to make the company competitive in the industry that they're associated with? All very important aspects of financial management. So our job today is to look at these financial statements and make sure we understand what they tell us. That's a key part of this strategy. You're going to be putting together in case number 3, you're going to be looking at and finding all these terms that I've mentioned here: current ratio, debt ratio, profit margin, and so on, for your company for the most current fiscal year. You're going to be going to the D&B Hoovers database in the library. You'll be going to the investor relations database for the specific company website and finding data to answer those questions and give an interpretation in a PowerPoint presentation of how you think your financial analysis is of your company, and are they in good shape or not so good shape? That's what case number 3 is about. So pay attention to this information here, because you're going to be using many of these terms in your case number 3. So first of all, let's take a look at the data in front of us. Here's a company's balance sheets for 2 years, December 31st, 2021, 2022. Now, I made the numbers a little bit smaller, but in the real world, these are in millions, hundreds of millions of dollars, even billions of dollars. But I made them a little smaller just so we can manage it and get a better handle on it. This company had a year-end stock price of $12.17 on 2022. So yes, it is a publicly traded stock. They had shares outstanding owned by the public of 250,000 shares of stock. Notice in 2021, they had 100,000 shares of stock. So it looks like they issued 150,000 more shares of stock. What happens when you issue stock? You will obtain cash. So we'll see that in our analysis. The company's tax rate, they must be from California, is 40%. Ouch. That's their tax rate. So here's the balance sheet. Remember, the balance sheet is a statement on a given date, in this case, December 31, a statement of the company's current assets. Current assets are assets that are liquid, have a lifespan of less than 1 year. Their long-term or fixed assets, which is property, plant, and equipment. Those are the total assets. So this company had total assets of a little bit over $3.5 million on December 31st, 2022. When you take a look at your company's balance sheets, as you probably already know, because you did a capital structure analysis in case number 1, is those numbers are a lot bigger. So you just got to get used to that. The liabilities and equity, which funds the assets of this company, are broken down into current liabilities, debts that you owe within the next 1 year. Long-term liabilities, debts that you owe that are due in longer than 1 year time, and the equity position or the ownership position of the company, broken down into 2 areas: the book value of the common stock and the amount of retained earnings or profits that the company has retained throughout its corporate existence. In other words, that number in December 31st, 2022 is $296,216. That's the total amount of profits this company has made since its inception as a company. So that's the balance sheet. And one of the key things of the balance sheet is to prepare a statement of cash flow, which takes the deltas of the balance sheets or the deltas or the changes from one year to the next and includes those as a statement of changes, a statement of cash flow. This year, the company increased their cash position by $6,718. The statement of cash flow, which we'll see in the next tab, shows us the breakdown of that $6,718, where money went out of the business, where money or cash came into the business in regards to operation, investing, and financing. That's the statement of cash flow. So it takes a lot of these deltas. Next statement is the income statement, which is a statement whereas the balance sheet is as of a given day. On December 31st, 2022, we had $3.5 million of assets. We had $3.5 million of liabilities and equity. But the income statement is for a period of time, 12 months. So for the period ending December 31st for 12 months, this company made a net income of $253,584. Net income is sales revenue minus operating expenses, in this case, cost of goods sold, other expenses, and depreciation. And we get our total operating costs. The operating costs subtracted from net sale gives us our earnings before interest and taxes. Another name for that is operating income. Operating income. I screwed that up. Let's take a look at that. Operating income. Or in some circles, it's called EBIT, earnings before interest and taxes. That's our operating income off the operations of the company. But that's where our business doesn't end. From that, we have to subtract out interest on that debt that we have on our balance sheet. In this case was $80,000. Interest, which is tax deductible on our corporate return. And from that, we now get our earnings before taxes. From that, we take 40%, which is the tax rate accumulated for this company, probably from their headquarters in California. So it's a California tax combined with a federal tax, 40%. Now we know why businesses are thinking about leaving and going to Texas. 40% of that operating income before taxes is $169,000. The balance is our dividends, or excuse me, is our net profit of the year. And then that net profit is closed out after dividends are distributed to the retained earnings of the company. That's part of closing the books, if any of you remember that from your accounting days. Let me show you how that works. This company had a profit of $253,584, and here they're telling us that they paid out 22 cents a share in dividends of that profit in 2022. The board declared a dividend of 22 cents a share to the shareholders, which there's 250,000 shareholders. So 22 cents times 250,000 shareholders is $55,000, or a payout rate of roughly around 22%. That's the dividends divided by into the net income. They paid out about 22% of their profits to dividends in $55,000. So when the company closed their books, they take their net income and subtract out dividends. That is $198,584 of retained earnings after the close of the books for year 2022. And notice our delta in retained earnings. It was $97,632 in 2021. In 2022, after we closed the books of this company, it's $296,216, a delta of $198,584, which is the difference between profits and dividends. That's one of the ways you can always check and make sure a company's books are in order. If that retained earnings, the delta equals the net income minus the dividends paid out for the year. If it doesn't, something's amiss under the hood of that company. So there's our income statement. So we see that the company grew their assets by about 600 some odd $1,000. And naturally, the equities and the liabilities increased proportionally, and they made a profit. Whereas last year they lost $95,000. They had a pretty good year of 253,584. But for financial management purposes, our most important financial statement for us finance people is the statement of cash flow. Where did this $6,718 come from? How did our cash improve by that amount? That's exactly what the statement of cash flow is. And here's that statement here. It takes the operations of the business, the financing of the business, the investing of the business, and looks at cash coming in, like net income, and cash going out, like an increase in accounts receivable. Cash coming in, like the selling of 150,000 shares of stock, and cash going out to pay liabilities. Cash going out, the purchase of short-term investments. Cash going out, the purchase of fixed assets, probably some equipment. The net effect of all these should equal $6,718. And that's what this statement tells us. It tells us that the company exceeded cash, or it had a negative cash flow from operations of $171,000. It had a positive cash coming in from financing of $246,000, mainly because we issued that new common stock. And it had a net cash going out of roughly $69,000 for investing in short-term investments and the purchase of new equipment. Couple things to note for most normal businesses, and that's a stretch to say that. Usually your cash flow from operations should be zero. It usually should be zero. Your net income, your depreciation, your borrowing more short term are all monies coming in. If your receivables and inventories are going up, in this case drastically, that's cash going out. It's meaning we're making sales and paying for products, but we're not getting the cash. We're not collecting the receivables. Or we're purchasing inventory, putting inventory into stock, and we're not selling it. That's why in every Super Bowl, that's why on every time you watch a sporting event, every time you watch television late at night or on regular commercial television, what's everybody selling? Inventory, automobiles, beer, clothes, whatever. Inventory is one of the key areas of advertising, is to sell that inventory and get it out the door. Because when you sell it, what do you get? Cash flow. And that's huge. The statement of cash flow says that this company, for all their accounts and all their rigmarole, only generated $6,718 of cash. That ain't good enough. And we'll see by that in just a minute. But that's what it tells us. As a financial manager, as an investor, you want to see what's the flows of cash coming in and going out of the business. And that's very important. Notice accounts receivable. I mentioned this earlier in inventory. Notice on the balance sheet, those accounts increased dramatically. That's negative cash flow. When you when you increase your inventories and increase your receivable, that's money that you are not collecting, and that thus is negative cash flow. When you depreciate an asset, even though you're not actually writing a check and that's an expense of 120,000, it's a positive cash flow. You're generating cash flow because you're expensing an item, but you're not writing a check. Kind of crazy. On the liability and equity side, when you increase accounts payable and accruals, you owe more money, but you're postponing paying that money for a later date. So technically, you're creating cash flow. Now, that cash flow is going to be diminished probably in the next month when you pay those bills, but that's how it works. When you pay off an old liability, like a note payable or a bond, that's negative cash flow. You're paying the debt. And when you're increasing your common stock holdings by issuing, in this case, 150,000 more shares of stock, you're increasing your cash flow by the proceeds of that stock sale to the market. And all of these are shown by section: operations, financing, and investing for this company. You're going to look at the statement of cash flows very closely in the companies that you have selected in case number 3. Now, the last financial statement that you do not need for any assessment, I'm not going to ask you any questions or ask any information from your companies about this, but I want you to know about it, is called free cash flow. The free cash flow of a company. The free cash flow tells us after they run the business, pay the bills, do they have any cash left over for new investment or growth? A lot of times investors, financial managers, financial analytics look at that free cash flow. Warren Buffett is a big proponent of tracking free cash flow. And here's the calculation for this company. Again, I'm not going to ask you to do this analysis. I just want you to be informed as MBA students. You have some idea about free cash flow because free cash flow is used in a lot of investment analysis about companies. Free cash flow is earnings before interest and taxes and taking out the taxes. All right. You take out the taxes from EBIT. Then the delta of operating capital, current operating assets, current operating liabilities. That's called net operating working capital. How has that changed in the last year? And long-term operating capital, which is how it's changed for fixed assets. So this company generated net operating profit after taxes of $301,584. They spent cash of $550,838, which is the delta between the working capital. In other words, they ate up $500,000 of cash in their operating assets and operating liabilities. They reduced their cash flow, money going out, because of the reduction in long-term operating capital, and that was basically the depreciation. We depreciated the asset, that's cash flow. The net effect is that's cash coming in of $102,950. The net effect of that, cash coming in, cash going out, cash coming in. This company had a negative free cash flow of $146,304. Not good. And how did that result? Here's the reconciliation of that free cash flow. We paid out interest expense. We paid out dividends. We paid out liabilities. We had money coming in from our stock sale, and we paid out short-term investments. The net effect of these, it reconciles, $146,304. So this company, even though they made a profit of $253,000, even though their cash position of increased by a very small $6,700, even though all that, due to the entire money coming in and out of the business, or what is called free cash flow, they generated negative free cash flow. In other words, they're not creating any new value from the business. After they spent all their money on the business and paid out bills and did all what they had to do down in this area, they ended up with negative cash flow. In other words, that money has got to be coming from another source in the next fiscal year. Negative free cash flow. Those are the key financial statement analysis of a company. You have to concern yourselves with the balance sheet, the income statement, and the cash flow statement. Those are the 3 areas of financial statement analysis that you'll be looking at in your company in case number 3, which will be posted this weekend. Make sure you understand those and understand what they are. In addition to that, we have what is called trend analysis, financial statement analysis. And here's a nice little page that's included in your article or in your spreadsheet notes for this week, taken from the textbook. Let's take a look at that. Okay, this is taken from your textbook, and I know some of you don't have a textbook. That's why I'm including it in this week's discussion. Taken from the textbook that goes through all the key financial statement trend analysis calculations that you need to be familiar with. It's broken down by sections: profitability, asset management, liquidity, debt management, These 4 areas, you're going to be selecting one equation from each one of these 4s and doing the analysis of your company in case number 3. Profit margin, day sales outstanding, fixed assets turnover, current ratio, debt management. All these are very key figures, but here's the most important ones, and I'm going to go over that you'll probably use in your case and in the future. But this is example and taken of how that is calculated and the equations you use. This is an important thing. I would download it and print it out. It'll help you in case 3. So going back to our spreadsheet tab, we've done the review of the financial statements, determined what the statement of cash flow is, what's free cash flow. And now we're going to look at trends, and it's called financial statement analysis from that page I just showed you. The 6 key ones that I think are most important are current ratio, current assets divided by current liabilities, debt ratio, total debt divided into total assets, profit margin on sales, net income divided by sales, return on total assets, net income divided by total assets, price earnings ratio, which is the stock price divided by the earnings per share, and the earnings per share, which is the net income divided by the number of shares of stock outstanding. So I'm going to practice that by taking a look at what are these numbers for current ratio for 2022. Remember, current ratio is the relationship of current assets to current liabilities. All right, it's a ratio. It's called the liquidity ratio. In 2021, it was current assets were 1.46 times greater than current liabilities. In 2022, in 2022, if we go to current assets on the balance sheet, 1,039,000, and divided by, let's go back here. Let's get organized here. Equals current assets divided by current liabilities. I took the wrong one. A little slow start today on our financial statement analysis. Let's go back here. Get that out of there. There we go. Now let's try it again. Balance sheet, current assets, there we go, divided by current liabilities. And we get 2.58. All right, current assets divided by current liabilities. That is too high. Notice, look at the industry average for this industry that this company is in. It's 1.25. It should be pretty tight. 2.58 indicates we have too much current assets. And that's rightly represented by that high amount of accounts receivable in inventory for this company. So the current ratio is a little bit steep. The debt ratio, last year it was 80.81% debt to assets. Let's see what our debt ratio is for this year. Balance sheet, total debt divided by total assets. And let's make that a percent. 2 decimal places, 43.78%. So dramatically, we've cleaned up. The industry average is 65%. So this company cleaned up their balance sheet by paying off some of that debt and making it a little bit more manageable, but it came at a very high cost. How did they pay off the debt, which is $420,000 and $500,000 of debt? They had to issue stock, the most expensive form of financing. Instead of making big profits or big cash flow generated off your profits to pay off debt, they had to go out and issue stock, which is the most expensive form, as you all know from the cost of equity analysis and the capital asset pricing model, stock is not cheap. And this company had to do that. In return, they lowered their debt position, but at the sacrifice of future capital fundraising. Usually, when you issue stock, you invested in assets, you buy more equipment, you invest in new products, and that's going to generate growth. Here, they're using the sale of stock to pay off existing debt. Not good, but that's what that means. The profit margin on sales, the relationship between net income and sales. So we go to our financial statement. Oops, let's make sure we have put in equal. And we go to our financial statements, net income. Net income divided by sales. Oops, I hit the wrong button again, Mr. Hassey. Net income divided by sales. And notice, let's put that into a percent, 2 decimal places, 3.6%. Not bad. A lot better than was in 2021. In other words, for every dollar of sales, we're making roughly about 3.5 cents. All right. That's our profit margin. Industry average, though, is 5%, a little bit higher. Again, what's our return on assets? Well, that's our return, net income, divided by the assets of the company. Net income divided by assets. Make that a percent. 2 decimal places. It's pretty good. 7.21%, a lot better than last year, but look at the industry average, 9.5%. What does this mean, return on total assets? It means that, let's say it's costing us 10% to borrow the money to invest in assets. Our return is 7.21%. Does that tell you anything? It tells you we're not exceeding our cost. We need not making enough profit on our assets. Our return is less than the cost of the capital. Not good. So again, this company is having some revenue and sales issues and profit issues, lost money in 21, made a profit in 22, but it's not comparable to other industry standards for this business. Let's skip over to earnings per share first. Earnings per share is the relationship of net income divided by the amount of shares of stock outstanding. And we'll make that a decimal, 2 decimal points. And make that $1. $1.01 a share. In other words, we're making a profit of $1.01. Instead of saying we made a profit of $253,584, we made a profit of $1.01. A lot of companies show this in their financials. It's a lot easier to digest. Last year, they lost 95 cents a share. This year, they made $1.01 a share. And of that $1.01, as we found out earlier, they paid a dividend of 22 cents. So they retained the difference between $1.01 and the 22 cents dividend. That's how much they retained. But this is their earnings per share, a very popular way of showing in earnings. And then the relationship of that earnings per share to the stock price is called the PE ratio, which is a very important investment return tool for many investors. So again, equals, we go to the financials. What's the current stock price on December 31st? $12.17 divided by the earnings per share, which is this number. And we get round to 2 decimal points. 12 times greater. In other words, our PE ratio and our earnings per share, the stock price is 12 times greater than the earnings per share. The market average of our competitors is 13, so that's pretty good. What that means is you don't want the PE ratio to be like Tesla. Tesla's PE ratio is like 250. there's no correlation between what the market assumes the stock is worth, its market price, and the earnings that that stock is generating. It's way out of whack. That's one of the problems that Tesla has. The stock is overvalued for a variety of reasons. Whereas in this company, it's pretty competitive. It means the P ratio is about normal, meaning it might be a buy, it might be a sell. I wouldn't buy the stock in this company because of their poor cash flow and their poor current ratio analysis. But at the same time, it's manageable. Their P ratio is pretty good. Many macro programming and investments say if a company's P ratio hits 15, you buy the stock. If the company's P ratio hits 65 or 60, you sell the stock. Those are some of the pre-programmed program trading that's used on Wall Street. So this is called financial statement analysis, taking a look at key areas of the financials and interpreting what they mean and how they relate to the industry you're in. Liquidity measurement, debt management measurement, profitability measurement, and market value. You're going to need to look at these 6, especially in your companies, for the current fiscal year ended, and your analysis of your PowerPoint. And we'll talk more about that this coming weekend. Now, in our lecture video on Friday, we're going to go to the next step further. We're going to answer this question here. What would be the projected amount of capital needed to increase sales by 15% in 2023? How much additional assets, how much additional debt, how much additional retained earnings or profits can fund if sales increase by 15%? And that's called the AFN, or percent of sales analysis. And that is this tab right here. And we'll talk about this in our Friday video. It'd be a good idea if you might want to look that over and see how it looks, or see if you can figure it out. And we'll talk about that in our Friday video. So again, these are the key points of a corporate financial manager, which you all are, of being able to interpret the data provided by the accountants on assets, liability and equity, profits, and cash flow. And your interpretation and being able to tell what is going on with this business. A couple of pros or good things. They made a profit last year. Their sales increased, which is good. But at the same time, they didn't generate much cash. All the cash they generated from operations, which was negative, went to pay off existing debt, and they needed to issue more stock, the most expensive form of capital, to do that. So this company has a cash flow issue. Going forward, that could be important to know about the future of this business. And that would be one of the analysis if you're looking at 2023. So again, that's where we stand here in week 6. This is what we're doing, reviewing these financials, making sure you can understand them, and then you're going to interpret them in your case number 3 for your specific companies. Again, case number 2 grades are posted. Again, the electrics case is posted. I suggest in this off week where there's no grading specifically, you download those files and take a look at the electrics case and begin to set up and think about the spreadsheet and the paper you'll be doing in that. And I will have a follow-up video on that on this weekend. But also, we'll be having a special review session on this case on Saturday, May 20th. Friday, we'll look at AFN and capital forecasting management. This weekend, I'll post and introduce case number 3 and have the electrics case review video. So a lot going on over the next 3 weeks. You got to manage your time, plan your time. That electrics case is going to take up some time. I'd get a head start on it this week before I lay case number 3 on to you next week. If anybody has any questions or concerns, I'll be around in my student office hours on Tuesday and Thursday nights via Zoom. Thanks, everybody. Have a great week. Let me just fire my face up here so you can say goodbye, and I can say goodbye to you. There we go. Have a great week, and we'll see you all at the end of the week. Adios.